Let's move on to another issue we've been talking about a lot, and that is Twitter and Elon Musk. A shareholder is suing Elon Musk in a proposed class action lawsuit for failing to disclose his major stake in the social media company. An SEC filing last week showed Musk taking a 9.2% stake in the firm, but the lawsuit claims that disclosure came too late, causing significant losses for investors. Let's bring in Jake Walker. He's attorney for that shareholder suing Elon Musk and Block and Leventon LLP partner. We've also got our very own Alexis Keenan joining in on the conversation. Jake, it's good to talk to you today. Lay out the claim for me.
Sure. It's really straightforward, and it is that the laws apply to everyone, including Elon Musk. There's an obligation to report to shareholders when you go above 5% ownership in a company, and you have 10 days to do it. And Musk failed to do that. He let 6 additional trading days go on before he disclosed that he had taken this ownership stake in Twitter. And when he finally did disclose it, of course, the Twitter shares were up $10 a share, over 25%. So with that, he obtained an unfair advantage against common public shareholders by failing to make this disclosure. And we are trying to remedy that unfairness by suing on behalf of those people who sold during those 6 days, many of whom sold their shares to Elon Musk, who paid less than he otherwise would have if he had just followed the law.
Jake, it's Alexis here. Now, your lawsuit, it goes after Musk individually. So damages, if the plaintiffs prevail here, they would come out of his pocket. So what is the range of damages at this early stage that you anticipate, given both this potential size of the class of plaintiffs, as well as the volume of alleged losing trades?
Here's what we know, Alexis. About 56 million shares were sold during those 6 days. Some of those may have been sold and repurchased, so not all of those shares may be damaged. But we know 15 million of those 56 million shares were sold to Musk. So at a minimum, he profited $150 million against the backs of common shareholders. And the damages are likely significantly higher than that. It's not just those who sold to him, it's those who sold at all during that time period who lost money. So I think damages are well north of $150 million. They're certainly 250, 300, potentially $400 million.
Now, another kind of avenue that isn't necessarily touching your case is that Musk has now filed as an active investor after filing late as a passive investor. Now, if the judge okays this case to move forward, is there any way that the judge can then strip him of that activist role?
Certainly not as part of this case. This case really is seeking to recover on behalf of the investors who sold during that window. And so it's pretty narrow in that regard. I would think that the SEC is looking at the issues, not just about the late disclosure, but also about his decision to file first in the form that indicated that he was not an active investor, and then quickly thereafter changing that. And I'm sure the SEC will be looking at that. They're really the outfit that has the ability to go after that decision and look at that and penalize him for that if it was improper in any way.
The tough part of your case here, of course, is intent. In this case, for an investor fraud case, it would require that the plaintiffs here prove that Musk acted by his filings either recklessly or negligently. So what are you expecting Musk to say to combat that? Does he have a defense here?
Look, the first battle for us will be to convince a court that we're able to plead that he acted either intentionally or recklessly. I think we can do that just from the profit motive. I mean, I know he's a wealthy man. I know he's the wealthiest man in the world. But there's lots of good case law that indicates that, even if you've got a lot of money, saving yourself $150 million is significant. And it certainly goes to his motive.
Jacob, it's Brian Chung here. I wonder if there's any degree of all of this that's also looped into Elon defining himself as an active or passive investor, because that was a big point of debate as well in filing. I don't need to go into the nuances here. The 13D versus the 13G. He originally identified himself as a passive investor and then joined the board, and then just kidding, he wasn't. Is that also giving some investors that are interested in this suit a little bit of confusion and desire for remedy as well?
Yeah, I'm sure it is. I mean, our case is really specific. And the fact is that once he disclosed the stake, initially when he disclosed it, he indicated he was not active. But it didn't matter. It was absolutely material to shareholders. And we can see that because of the way that Twitter's stock jumped. It went up over $10 a share, over 25%, even with him not disclosing his active intent. He very quickly, changed that filing and said that he'd be active. There was then obviously the drama with joining the board. Our case really doesn't get into that. I think that, again, is more an issue on the SEC side, but I think it's certainly drawn a lot of interest on behalf of shareholders. We're really looking to say that what he did to people who sold their shares during that time where he was buying but didn't tell when he was supposed to, those are the people who have been damaged in our case that we're looking to recover from. And, he's not above the law. He had an obligation to file that report, within 10 days of going above 5%. He just didn't do it. And he had a good reason not to do it. He saved himself a lot of money by not doing it. So that's the wrongdoing we're going after.
Yeah, and Yahoo Finance did, by the way, reach out for comment from his side of things. We haven't heard back, but a developing story for sure. Jacob Walker, attorney for the Twitter shareholders suing Elon Musk, and again, a partner at Block and Leviton LLP, alongside our very own Yahoo Finance's Alexis Keenan for that conversation. Thanks so much. Appreciate it.